Hello everyone and welcome to another property feature video with Nidal Rasheed. And today I'm excited to be sharing with you a unique and exclusive property investment opportunity that many people would not have heard of before. And I am referring to the NDIS investment program. So for those of you who've heard of it, you probably know a little bit about it. For those of you who don't know about it, then this video is going to be very worthwhile and very valuable for you. So as you would have seen from the headlines and the body of the email that came with this video, this is an investment that will return upwards of 14% gross rent return. So we are talking about close to $90,000 in rent per year on a property that's purchased for about $620,000. So when you do the maths, that's obviously about $1,700 per week. So in this video, I'm going to show you how the numbers filter down and what the net return is going to be for you as an investor. Now, as a bit of a disclaimer, this investment opportunity is not for everyone. Obviously, this is particularly for those who are looking for a cash flow positive style of investment. So it's not for people who are chasing capital growth. It's not for people who are looking at doing some developing or equity uplift or anything like this. This is purely for someone who's looking at doing something that's going to give them some good, consistent, long-term cash flow whilst utilizing some of the government schemes out there. I am referring to the NDIS, which is the National Disability Insurance Scheme. And, obviously by them providing some specialist disability accommodation for people who've got disabilities but want to continue living a normal lifestyle. So what I mean by that is that there are some government bodies and government incentives out there that help people with disabilities continue living a normal lifestyle. So living in a normal home in a normal suburb, still having the special care that they need, but not being in a big facility like a nursing home or like special care facilities or anything like that. This is for people who want to continue living a normal lifestyle. And what I mean by that is that these groups are now building homes. So they're approaching builders and getting these houses built to spec. So I'm talking about getting houses built with large doors, with little courtyards, with breakout rooms, with houses that accommodate for someone with special needs. And the way the scheme works is that there's a carer that lives in that house full time with the participants. Now, in this example, this is a 3-bedroom home and this would generally house 2 participants. So you'd have 1 bedroom for the carer and 1 bedroom each for the participants in there. Now, as you can see from the main bedrooms, so the main bedrooms will generally have a bigger bathroom and wide doors and big showers for people possibly in a wheelchair or people with special needs. Same thing with the one at the back. They'll have doorways going in from a little private courtyard into their room. They would have a normal house as any other normal property would be. Still getting their double garages, their open plan living area. In this case, they're getting a little breakout room as well and an alfresco under the main roof. And the way the numbers work from an SDA provider's point of view is that these houses, because this has 2 participants, basically the SDA or the NDIS program will contribute $37,520 per participant per year, right? Now the tenant or the person who's living there, the participant, still has to contribute some rent. Obviously, it's going to be reduced rent, which in this case is $7,128 per year. So when you add the two together, so 7,128 plus this 37,520, that means there's $44,648 in rent per participant that's coming in to this property. So when you think about it, 44,648 times 2 is going to give you the 89,297. Now, there are a few challenges that come with putting an investment like this together. All right, and I'll run through those when we come to doing the numbers. But before I do that, I just want to show you the area of where this is located. So This is in a state called Chambers Chase in Park Ridge. So for those of you who know Park Ridge, it's an area between Brisbane and the Gold Coast. So if I just zoom out of the Brisbane map, there's Brisbane CBD here, and there is the Gold Coast just down there. So it's just under halfway between Brisbane and the Gold Coast, but it's also strategically located between Brisbane, the Gold Coast, and Ipswich. So Ipswich is the second largest council in southeast Queensland, and obviously being accessible to all three major cities in southeast Queensland is going to be a benefit. Now, Park Ridge itself is a high growth area, so it is an area which is seeing massive population growth. In fact, there's a huge housing demand that they need to build in order to accommodate with the people moving into the area, particularly because people are moving there because of things like affordability, jobs. There's a huge amount of work that's come out of the ground over the last few years. Things like new retail precincts, new hospitals, new infrastructure, a lot of construction going on, as well as new education facilities, is all creating a huge amount of work in the area, which is having a good impact on their local economy. So Park Ridge is within the Logan Council. So Logan is going through a lot of gentrification. So historically, it's been known as a lower socioeconomic type of area, but over the years, it's definitely been gentrified by having a lot of new estates getting built in there. So it's been a popular area for first home buyers, young families, and people, moving in to an area that's accessible to all major cities and still getting, good value for money. So we've been bullish on Park Ridge over the years. We've actually seen some good growth happen in there. We've been operating in Park Ridge since about 2016 and can obviously, attest to the growth that we've seen in the area. So we're quite happy with recommending that as a suburb, as an investment, even for someone wanting to buy a house and land package for capital growth. So we're pretty bullish and happy to recommend Park Ridge. Now, when we go to the actual property itself, so this particular property here, even as a normal property, could always become a 4-bedroom. So you still got your 3 bedrooms, but then this breakout room could obviously be converted to a 4th. Otherwise, can be a 3-bedroom with 2 living areas, al fresco under the main roof, open plan living. You still get your garage, a separate double garage, separate laundry, and this is going to be a nice turnkey property where the land price is $222,000, the construction price is just under $400,000, so you end up with $621,000. Now, let's look at the numbers and talk about the challenges. So first thing that comes to mind is obviously that the construction price is quite high, right? Because obviously they've got to build this to a certain standard. So although the construction price is with the land comes to $621,000, generally speaking, those properties, if you were to build a normal house, you're probably looking at spending about $550,000. Right, so the first challenge that we're going to have is that you're spending more than what that house would actually cost to build if it was just a normal house. So if you were to base it on comparable properties in the area for another 3 or 4 bedroom home, then you're obviously overpaying for that. But you're overpaying because there's a lot of extra inclusions that go in to make this compliant with the SDA and the NDIS program. So that's the first thing. Now, the way we overcome that challenge is obviously by having a bigger deposit. So generally speaking, you would need a 10 or a 20% deposit to pull off an investment property. In this case, I'm allowing 30%. So we're talking about $186,000 in terms of a contribution from the investor. Now, the building inspection obviously is going to be as normal, $350 for your due diligence costs, and that's just to make sure that we pick up on any defects at the time of completion, to make sure that the builder can rectify that before we get the keys and get the final handover. In terms of the stamp duty, it's still going to be payable only on the land portion, so that comes to just under $7,000. And your legal fees in Queensland are a little bit higher than SA, but we're looking at about $2,000. Well, it's actually about $1,500, but I've overestimated a bit and allowed up to $2,000 for legal fees. Now, when we look at the loan setup, now it's very important to note that not all lenders will lend on this type of property, okay, or this type of scheme. So there are a few lenders that will be able to provide the loan. That's something that we can guide and direct you on, so that's not an issue. In terms of the setup fees, we're obviously allowing $400 for a loan to for a loan setup. So that's assuming you're going to take up some kind of package that's got credit cards and offsets and all that kind of stuff. But because of the amount of deposit we're putting in, obviously there's no lender's mortgage insurance in this case. So that's what I meant when I said this is not going to be suitable for everyone, because it requires a particular type of investor that would qualify for something like this. Now, in terms of the improvement and selling costs, because this is a brand new property built to spec, built for a certain purpose, there is no improvement cost. So it's not like you're buying a house and then making it compliant. This is built to a certain standard to make it compliant from the word go. The selling costs of the property, if you decided to sell it and offload it down the track, I've allowed 2.2% for an agent's commission, $3,000 for advertising, and $2,000 on your legal costs. So in terms of your transaction costs on the way out. So these are the one-off capital expenses that you would expect. Secondly, we would look at the annual income and expenses. So this is made up of your rental income, your property, and your loan. So your property expenses, sorry. Now the rental income, as I mentioned, in the first year, we're expecting about $1,717 per week in rents coming in. Now, the second challenge that we would have with one of these type of properties is before you can get an NDIS participant living in there, it's got to be stamped, rubber stamped. So it's got to be approved. And that process can take up to 12 weeks. So I've allowed 12 weeks vacancy. So we're expecting 3 months with no tenant in there. So again, this is something that you would, as the investor, would need to cash flow in the first few months just to make sure that we get it to a point where it's compliant. And we've got obviously reduced rent in the first year, which is about $68,000 per year. Now, the good thing though is once you do have a participant in there, it's very unlikely that they're going to move out unless they have to be transferred out to go to a hospital or a special care facility. So the good thing about it is that you're not going to have vacancy on this, every year because of changeover of tenants or anything like that, because this is a specific type of tenant that's moving in there. But as any normal tenancy would have, there is always going to be a review on the lease. So there's a 12-month annual review on this lease, and as you can see, that's obviously that's going to be in line with CPI. So that's something that would be managed by the SDA provider. So in this case, the SDA provider is the person that's going to be looking after the tenancy, so the tenant placement and the management of it. And that works like any normal property management group. So they would charge you the same rate at 8.8%, and they would obviously look after all the administration side of it. Now, in terms of your ongoing property expenses, the first section is going to be for the rates. So council rates is going to be roughly about $2,500 a year. So I've allowed $3,000 in this example. We've also allowed $1,500 for building insurance. So generally you'd be paying about $900 to $1,200 on a comparable property, but because of the nature of this property, we've allowed $1,500 for the year. There's no body corporate, it's a Torrance titled property. There's no repairs or maintenance or cleaning contracts because that's obviously looked after by the carer. However, we do have an allowance for garden and lawn maintenance because of the nature of the tenants. They're not expected to maintain the garden and lawn, so we generally allow about $40 to $50 a week. So we allow $2,500 a year on garden and lawn maintenance. Now, the reletting fee. So the letting fee up front, you obviously pay it for the first time a tenant goes in, and that's generally a 1 week's rent. However, the reletting fee, so every time they sign on for another 12 months, then that's obviously going to be zero. So there's no reletting fee in this example. So, obviously it's going to be a little bit different from your normal tenancy where you have to find a new tenant or re-sign a lease or whatever it is, and they charge you another 1 week's rent. Because this is an annual expense, I have not included that first letting fee in there. So I can actually include it in the first as a one-off. Now for the, and the property management is at 8.8%. So standard rates, obviously, for managing the administration. Now for the loan setup, as per my all the other examples that I use, I always put it on interest only, just to show you the raw figures. So obviously we can convert this to principal and interest, and that's no problem at all. So we've done this on interest only over a 30-year loan, again with a 70% LVR. Now, what I've done is I've allowed up to 4% interest rate. So keep in mind, interest rates are the cheapest they've ever been. You're going to get the interest rate on this investment a lot cheaper. So probably in the threes, but I've allowed 4% just to be on the safe side and gives us a bit of a buffer. And in terms of depreciation, I've worked on a sliding scale depreciation and been very, very conservative with this amount. So obviously on a $400,000 build, if you were depreciating 2% of that every year, even at the very, very minimum, so after the 10-year period, you're still going to be, you can still expect at least 10 grand a year after year 10. Whereas I've started off year 1 with 10 grand. So obviously been very, very conservative in this case. Now, in terms of market factors, look, the CPI is still going to be 3% and our annual capital growth is at 4%. So I've just gone a little bit less than what we would expect in there, just for the sake of being conservative. And I've done this on an example of someone earning $80,000 a year. But I'm going to show you what that would look like if that person was earning $0 per year as well, because this is a positive cash flow property. So there's obviously tax implications in this. So when we look at the numbers, you know, even on a property that you buy for $620 that might be valued at $550 in the first year, over a 10-year period, we're still expecting a bit of capital growth. So we're still expecting about $260,000 worth of growth over that 10-year period. So if you average it out, that's still $26,000 a year in capital growth that you're going to be paying for. Now, yes, you'd probably have to hang on to the property for about 3 or 4 years before it breaks even in terms of capital growth. So if you're buying this with the intention of selling quick or, you know, as a capital growth strategy, this is not for you. But the cash flow is what makes up for this. Excuse me. Now, when we look at the loan and equity position, because I've set this up as interest only, you'll see that the loan amount stays the same. However, I can show you an example with principal and interest, but for the sake of this example, we're setting this up with interest only, just so that way you get an idea of how the raw numbers look like. Now, from a rental income point of view, again, allowing 12 weeks vacancy, so 3 months without a tenant, you're still going to come out with about $68,000 worth of rent, which translates to a 11% gross yield and 9% net in the first year. Now, that does jump up in the second year. You'll be looking at about $90,000 worth of rent, which translates to 14.8% and then 12.3% net. So generous amount of rent coming in. Now, when we look at the expenses, again, if we're working on 4% interest, then we have $17,000 going out in interest costs. We've got property expenses of about 13 grand. So all in all, we've got $30,000 going out, 68,000 coming in. So that means we've got a net cash flow of $38,248 per year, which is $736 per week. Now, because this is positive cash flow, this is another income that you're making. So naturally, you're going to have to pay tax on that money. But because we've got depreciation benefits, you're not going to pay tax on all of this. You're going to get a 10 grand reduction on the, at the very minimum, which means you're only going to get tax on 28,000 rather than the 38. So then you're paying about 10 grand worth of tax. So the net result is you're still going to come out with about 27,826 in positive net cash flow after tax, which works out to be $535 per week. Now that does go up obviously over the years. So, you know, over a 10-year period, you could expect sort of, you know, somewhere around $1,000 per week net cash flow after tax. Now, if you are near retirement and you're going to be finishing up from work in the coming years and you're going to be on $0 taxable income, this is where it gets pretty exciting, because, you know, you're still making the same net cash flow before tax. However, because you've got less income to pay tax on, now you get to keep more of that money. So instead of, you know, coming out with $500 in the first year, you'll be coming out with $700. And after the 10-year mark, rather than it being $1,000, it'll be around $1,200. So obviously the less money that you're making and the less money you're paying tax on, then obviously the more money you get to keep out of this investment. So Look, I always recommend get some accounting advice before you make any financial and investment decisions. This example is really just to show you a scenario of how the NDIS program works. I hope it's opened your eyes in the sense that, look, there are opportunities out there for you to make some really good cash flow whilst having a brand new property that doesn't give you the same headaches, and not having to go into dodgy areas and having to buy old units or anything like that to make that same cash flow or that same yield. So these are quite exciting. They are unique. They do have their challenges, as with anything. There's always an element of risk associated with any investing that you do. So again, always consult with your accountants and advisors and make sure that that's the right thing for you before you make a decision on this. If you found some value in this, please let me know. If you have any questions or you want a particular scenario done for you, again, let me know, reach out. I'm happy to help. And as always, I hope you guys are having a great day, and I look forward to seeing you on the next video. All right, all the best and take care.